Hey traders, Nick Shaheen here looking at FedEx, FDX. This is the heartbreaker. They can't catch a break. 1 foot forward, 1 step forward, 2 steps back, so to speak. Today, I believe UPS is also in the same boat. They're both falling. The markets are falling, but these guys are falling a little bit more, about double. Down 2% when markets are about, oh, never mind. We're climbing out of the hole. But anyway, so what's going on today? Another of the same headline. Amazon, Amazon, Amazon. Love Amazon. But it's the same headline. Oh my gosh, Amazon is willing to take lower rates. Well, duh. That's how they break everybody. They play with lower margins. They can do that. They know how to do that. So, you know, the technical upside potential has been ruined, and now it's back to the neckline from which it broke out, which is 171-ish. So what do I do if I have the shares? If I have the shares, I believe it's too late to get out here. So I don't sell it on this. There was a gap. They kind of filled it. But they have a lot of catch-up to do. So I have to evaluate why I'm long, first of all, if I own the shares. But there are things to do. So I can sell calls, covered calls. That's old. Okay, so price to earnings, it's 15. So it's not bloated, but it's not dirt cheap. Let's see how it compares to UPS. I know one of them is more sensitive to Amazon than the other, but recently this week, as I believe I heard one of the CEOs say, the Amazon effect, they said that not one client has a giant portion of their income into their P&L. So I don't know how big of risk it actually is when it comes down to it. Yes, there'll be pain when they sever. If they sever from Amazon, it's a beast. You can't just ignore Amazon. It's just I think they overreacted to the downside. So, so to establish the fact, it's not bloated. There's no reason to panic out of it just because of 1 day down. We have something to shoot for against on the downside. Where's Christmas? This was the Christmas panic. And we're off of it. So if you consider this an overshoot, it should find support thereabouts. 167, I'm guessing, short term. So maybe I put my stop there. It depends on when I entered it. So on the upside, what can I do? I can sell calls. What are these? These are covered calls. I never sell calls naked, ever. This is the equivalent. If you do that, then you're shorting the stock. And what's wrong with that? The losses are unlimited. Well, how's that different than buying the shares? If I buy the shares, my losses are 100%. I can lose my money. With shorting, you can lose your money and then some. Because as long as stocks are rallying, then you're losing. Yeah, it seems inconceivable here, but you don't know. It happens. All right, so let me try to get a couple examples of what calls I would sell. All right, here we go. This is FedEx options chain I chose February. If I wanted to get cute, I could, sell this week's, which has 1 day on it, and I could say, okay, it's not going over 173 and try to. Most people don't want to spend time just plastered to the PC. I could do that. I'm just going to February. It's a nice round number. It has 23 days on it, and most importantly, it does not fall into an earnings report. I think March does. So. Why do I want to do that? Because on earnings, you have spikes, up or down. And if it goes up, then I get called away from my shares, and I don't want to do that. All right, so looking at this, this is where they're at now-ish, 172 right here. They're fighting it out right here. And if I look at it, I'm going to say this contract is expecting about $10 move up or down. So they're saying it's either going to go to one here or it's going to go to here. So if I wanted to sell calls, I'd want to sell somewhere around here. So if I sell, what does that mean? So if I can sell one contract for every 100 shares I have. And in this case, I would collect $100. It goes into my account today. If nothing happens, then that $100 is mine. I basically created dividends. That just lessens the pain of the stock not moving. What happens if it goes through that? If it goes through that, I may be called away from my stock. What does that mean? Because by selling that call against my stock that I own, I'm saying if it goes above 182.5, I will sell my shares at 182.5. So if it goes to 185, I missed out on $2.50 of winnings, but I kept my $100. Okay, so my break even is in between that. Worst case scenario, I can turn around and buy them back. But that's a way of generating income, okay? So if I wanted to hold it long term, then I can do it even further out. I'd go out to, January of next year, and I go a lot higher. I'll choose another, maybe I'll do that at the end. But I wanted to introduce the concept to a lot of people. Selling covered calls. They call them synthetic dividends sometimes. Well, I've referred to them as that. I don't know if it's a common name for them. I basically create dividends if I own the shares. I'm putting an asset to work. I can do the same if I own calls. What does that mean? Okay, if I own July or even January calls at 185 or 182.5 or 180 or 177, I can sell against them. And I usually don't sell lower. What does that mean? So if I own a $175 call out in time, 175, if I own this level out in time, I can sell against it shorter term or higher. So I can sell this one, and I wouldn't be creating extra risk. I can sell this one, and this one, or higher. What does that mean? It means that I'm not on the hook for extra losses in case it spikes through. Because if I sell this one, now I'm short at 172.5, and I'm not long until 175, so there's extra risk there, okay? Nuance there. All depends on the portfolio, intention, what do you think of the stock, how long do you want to hold it? So there's a lot to decide, but the concept is always the same. I have an asset, either I own the shares or I own calls, and I want to put them to work by selling shorter term risk against them without creating extra problems. Shorter term risk against them. Shorter term. I wouldn't do this because this has earnings. Okay, so this is FedEx. This same concept can be done on almost every stock. The higher the stock price, the easier it is to do because the premiums are huge. But stay away from the earnings. For me, I stay away from the earnings. Okay, that's one way. Also, sometimes you can defend the stock for free. What does that mean? So if I owned the shares and I was worried about an event, I'd sell the calls, take the money, and buy puts. So this covers me for 23 days from a stock debacle. So if it goes to 0, I'm out at 160. And it cost me nothing. Why? Because I paid 117, I collected 117, I'm defended for free. Boy, this is 2 lessons in one. Okay, so the first one, I said how to create income from covered calls, selling covered calls. This one is how to protect myself from a debacle for the next 23 days. I'd sell this, buy that. What does that mean? If price moves above this, I have to sell my shares at that. I'd enjoy profits through until, and then I'm out. But then I keep my dollar here, but it doesn't matter because I paid that one here. So if the stock spikes, I'm out of the stock, I profited some more, and this was a waste. However, if the stock goes to 0, obviously an exaggeration, this goes to 0, I wasted my money there, but this did its job. As soon as it falls below 160, I can call out and say, hey, you know what, somebody sold me this put, where are you? Here's the stock at 160, thank you very much, you're on the hook for the rest. Okay, or this would be a lot more than 117. If I want to hang on to the stock, I don't have to get away from it. I can sell the put itself. It'll be probably $3. So I would have made some money here to offset this. So plenty to do with the options given if I own the shares. Create income or protect. I can protect for a cost, just buy this. I can protect for free, buy this and sell that. All depends on the particular situation. All right, Nick signing out.